Welcome everyone to our Smart series where you think smart, close more loans. We're glad to have you all here. Usually we're talking about a lot of our products in the non-QM space, right? Our DSCR, our bank statement loans, our just miss, but we're going to probably expand and reach out even outside of our non-QM and talk about confident condo lending. There's just a great opportunity when it comes to condo in general, and we do a great job with our Smart series as well. So we'll be covering all of it. Let me introduce you to some of the people that we have on our panel today. Obviously, my name is Don Chiesa. But we have Claire Kafori with me. She's our business development manager on the non-QM space. And then we are lucky to have Gretchen Rowe on our call as well. She is the vice president of our project review team here at Newrez and is one of the leading industry experts in the space. She brings decades of experience, originally starting out at, spending some time in the project approval space at Wells Fargo, even running her own business and approving condos in the space. She's been with us for a considerable amount of time, and she runs all of our review strategy and plays a critical role here at Newrez. And we're glad to share some of her knowledge with all of you. And then also helping us answer a lot of the Q&A is Brenda Dakin, and she supports Gretchen. So glad to have them all here. As I just said, the Q&A, if you go to the bottom and hover over the bottom, if you don't see Q&A, click on the three dots and the more. But we'll be open to answering any questions. Just post them there while we're going through our webinar. So with that, I'm going to turn it over to Gretchen. Thank you for being here and look forward to what we have to talk about today.
Thanks for having me. It's my favorite topic. We're going to talk about today the top 10 questions to ask when you have a condo, the recent changes in the guidelines. They're mostly really good. Top challenges with condo financing that we're still having, the reasons why projects might not be eligible for financing, and our smart solutions, the things that Newrez can do on these projects when they don't quite fit in the warrantable space. Next slide, please. So somebody comes to you, they have a condo. What are the questions that you should ask? First question, is the project new or established? If it's new, it doesn't mean that we can't lend in the project. It just means there's some additional requirements that we'd want to evaluate at the time that you take in that loan application. We have to warrant the legal documents, make sure that 50% of the units are sold or under contract to owner occupied or second home, and we have to verify that the project's complete. So we're looking for those things. The next question, I already said that, sorry. New projects, at least 50% of the units sold or under contract to primary second home. So if it's predominantly being investor buyers, they may not fit into Fannie or Freddie space. Next question. Does any single entity own more than 25% of the units? So when you have a project, I'm going to continually throughout this presentation use a 100-unit condominium example. So in 100 units are in a project, one entity or person owns more than 25 of those units. The project is probably not eligible for Fannie Mae or Freddie Mac financing. Next question. Is there any commercial space? So think like either high rise where maybe the bottom floor is commercial, maybe even above that there's apartments or hotels, and then the condominiums sit on top of that. Or think about maybe sort of townhome style where the first floor is maybe a retail space, like drive up, park right in front of it. That's usually when we have commercial space. The Fannie Freddie guidelines require no more than 35% of the project, that's by square footage, be commercial. So we can review for that. Are there any special assessments? So special assessments are in addition to the HOA dues. They're usually for additional work that the condominium project has approved to be done. Maybe it's for deferred maintenance, or maybe it's just something they're adding to it, or maybe increased costs. So that's a question we need to ask. We'll talk about that more later. And is there any deferred maintenance or critical repairs? So if they have a special assessment that relates to any of those items, we need to know if it's related to any critical repairs. We're going to talk about that a lot more later. Does the HOA allocate at least 10% of their budget to reserves? Currently, that requirement is 10%. In January, it's going to be changing to 15%. We're going to talk about that a little bit more on another slide too. So you want to ask if they're allocating that minimum percentage in their budget. And then delinquencies, HOA due delinquencies are the unit owners are more than 15 of our 100 unit project, more than 60 days late on their payment of their delinquent, they're not delinquent yet, of their HOA dues. Next, does the master insurance have any exclusions? So the kinds of things we're starting to see is, okay, our master insurance is in place for our property coverage, but it doesn't cover hurricanes, named storms, wind and hail, things like that. Is the HOA subject to any litigation? Most litigation is ineligible. We can work with litigation where it's like slip and fall, insurance is defending. That kind of litigation is generally eligible. Most other litigation, particularly structural defect litigation, is not eligible for financing. So we want to be sure to ask those questions up front. Next slide, please. New project review guidelines. I just want to make one more comment about, before you go to the next slide, those top 10 questions to ask. If you ask those questions and you get an answer that is no to any of those questions, I would recommend that you get the documents, whether it's litigation or a questionnaire for single entity or condominium docs for review of commercial space, for my team to review. We can review those and see if it works in the space, see if the litigation's eligible. We can pre-review those items before the loan comes in. Sorry, go ahead, next slide. New project review comparison guidelines. So on March 8th, there was a big release, a guideline release from Fannie Mae and Freddie Mac, and we're going to go over those changes. Next slide, please. So the first one, we've had a lot of challenges probably since 2024. We started seeing ACV on roofs. ACV is actual cash valuation. It's a depreciated valuation on the roof. A roof is usually the biggest capital item in a condominium project. Capital items are items that have an estimated life of 5 years or more. So when the previous guidelines prior to March 8th were that the project had to be insured to 100% replacement cost, and we were seeing that actual cash valuation on roofs. March 8th, that guideline changed, and Fannie Mae and Freddie Mac are now accepting ACV on roofs and non-building items. Non-building items does not include siding, windows. Those are still part of the building, but it does include things like fences and pools. Next slide. Per unit deductibles. So this was another challenge we were having prior to this guideline change that we had in March 8th. Prior to the guideline change, we were really struggling because that was one of the ways that HOAs were trying to make insurance more cost effective with the rising costs of insurance. They were having more deductibles. We were seeing things like water and sewer deductibles, named storm deductibles, wind hail deductibles, and we were really struggling with those with the 5% maximum on the project. And we have to do this crazy calculation on the per unit deductibles. So Fannie and Freddie updated their guidelines to allow $50,000 per unit deductibles across the board. So what that means is if we have a master insurance policy, it may have a per occurrence deductible. Let's say for the property insurance, for example, it might be $100,000. And then a per unit deductible in addition to that. So maybe my unit is the unit that started the kitchen fire that burned down the building. I might have $50,000 that I have to pay. So that's a per unit deductible. And they started doing these with the thought that not all units in the project would have this all at one time. It would be just a portion of it. But then we had to review it that way. So it didn't work. So this has really opened up a lot of projects to be eligible with those per unit deductibles. And they can be for any peril. So we can have layers of them, like a $50,000 deductible for one thing, a $50,000 deductible for another thing. We would assume that only one peril would happen at one time when we can review them that way. Next slide, please. Waiver of project eligibility. This is a really exciting guideline. We've always had really big challenges with the really small projects. People come to us and they say, well, it's not really a condo. What they mean is there might not be a master insurance policy. That's another issue, but that they don't meet, that they don't have board meetings, they don't pay HOA dues, and it's still legally a condominium, and we still have to review it. So prior to this guideline change in March, the 2 to 4 unit, if the project had 4 units or less, we were able to waive most project approval guidelines. So all we had to do was verify that the project was not a condotel and that the insurance met lending guidelines. Now they've expanded this to 10-unit projects. So up to 10 units can be reviewed under this policy, where we don't have to review things like we talked about in those top 10 questions. We don't have to review single entity. We don't have to review commercial space. We don't have to review litigation. So all of those things are waived. We have to verify that the project is not a condotel and verify that the project meets insurance guidelines. There is a little extra that if for 5 to 10 units, we have to verify that it's not part of a master association to be eligible for this waiver. We've still never seen a project of 10 units or less be part of a master association. So it's really rare. Next slide, please. New condo projects in Florida. So prior to this guideline change, any new construction projects in Florida had to be reviewed by Fannie Mae PERS. That means that any lender who's a Fannie Mae seller servicer had to gather documents, complete all these forms, pay fees. There were fees of around, it varies by project, but let's say $1,500 to $2,500, pay those fees, submit that project to Fannie Mae for review and approval. And on March 8th, 2026, they lifted that guideline. So it kind of leveled the playing field for Florida projects, where now lenders can do a lender warrant to the project just like we can in any other state. So they are no longer required to be submitted to Fannie Mae for approval in Florida. And that was required for Freddie Mac too. Freddie Mac required Fannie Mae approval for new projects too. That's waived for both of them, effective March 8th, 2026. Next slide, please. Investor concentration limits. This is really exciting because when you're doing an investor loan prior to this guideline change, if we were doing an investor loan, the project could not have more than 50% of the project be investor owned. That is, on our 100-unit project, 50 of the units are owned by people who have maybe tenant occupied units. So they lifted this guideline. So now it opens up investor financing in a where there's no investor requirements anymore at all. So it's a really big lift. Next slide, please. Okay, this is kind of the pain point. So limited streamline review process. So right now we can do a limited streamline review. What that means is that under certain LTVs, so it varies by state, whether you're in Florida or not Florida. But for example, if you have 10% down on a primary residence in a state that's not Florida, then we don't have to warrant to the budget. We also don't have to warrant to delinquencies and a couple other things. But the main thing is the budget. So that's going away August 3rd, 2026. It's coming, and those processes will be retired. So we won't be able to waive the review of the HOA budget for projects consisting of 11 or more attached units. And we're getting a lot of people are very concerned about this guideline change. And we are Newrez, we started reviewing all of our projects that had a budget in them, whether they were going limited streamline or not. And we found that over 50% of those, actually, it's way higher than that. Over 50% of the projects we reviewed have the budgets. Of those, it's something like 95% of them actually meet those guidelines. In addition, the reason that they're getting rid of this is because getting rid of the limited streamline review process is because with the acceptance of that actual cash value, that depreciated valuation on the roofs, that there's more planning needed for these HOAs to make sure that they have the funds available when their roofs need to be replaced, and our borrowers aren't at risk for special assessments or at lower risk for special assessments because they don't have the funds to replace these items. So it kind of went hand in hand. They rolled out in March the acceptance of that depreciated roof coverage for the insurance. And then they gave you some time, gave the HOAs some time till August 3rd to implement that minimum of 10% reserve allocation required on the HOA budgets. So they really are very, very connected. In addition to that, we found that most projects that are not allocating a minimum of 10%, we really, if they're following a reserve study, it's probably closer to 25%. Most of them are having deferred maintenance and special assessments. We're seeing so many projects with those challenges. We're probably not approving them anyhow under the limited and streamlined review process. We still have to warrant 2 critical repairs. That includes deferred maintenance and special assessments. So they don't waive those requirements. And if they're not allocating anything to their reserves, they're probably not eligible anyhow. Next slide, please. So replacement reserve requirement. So we're talking about that. So the current guideline is 10%. So you have a budget and maybe the budget is $1 million. An estimated 100,000 of that $1 million budget needs to be allocated to basically a savings account for future capital expenses. Again, those are capital items of the improvements that have over a 5-year estimated economic life. So currently, that's the guideline that we're looking for. If they don't have 10%, we still can accept a reserve study. If they are following the reserve study that was completed in the last 3 years, we can accept that in lieu of the 10%. In January of 2027, that there's going to be a new guideline of a minimum of 15% will need to be allocated. So in our $1 million budget, now, instead of $100,000, that HOA needs to be allocating $150,000 to their replacement reserve allocation, that savings account that they have for when that roof needs to be replaced. So, for example, maybe they have a 20-year roof where the economic life is estimated to be 20 years. It's 10 years old. In 10 years, they're going to have to replace that roof. They have a reserve study that estimates the cost of that roof 10 years from now, and they have to save that money up. They kind of break it out for how many years they have left. That's what a reserve study does. So we're planning to see those increases because we know that quite a few projects have special assessments, and it adds a risk to the borrower and also us as the lender, and then also the HOA, because if they have special assessments and they're not eligible for warrantable financing, that prevents those buyers from maybe getting a refinance or a second mortgage to pay those special assessment fees. And it also limits their ability to refinance, or sell that unit and people to buy units in those projects. So it adds additional risk to the buyer, the HOA, and us as the lender. And that's why those are going up. Next
I
slide,
know,
please.
Gretchen, a couple of them seem like they've given the lenders a little bit of time, right, with increased reserves or the limited review going away. So we got a little bit more time there, but it's coming up fast. But you covered a bunch of them that went into effect March. Are you seeing a bigger lift out of some of them than others?
Huge. So when prior to that announcement in March, we were declining. It was over 10% of the projects just due to insurance. Brendan nod for me, right? That's right. Brenda's tracking it. It is over 10% that we were declining to ineligible insurance, mostly due to that actual cash value or per unit deductibles. Thank you. And then since then, it's dropped down to something like maybe 2%. And it's mostly for those per occurrence deductibles. So on the whole policy, and for exclusions like name, storm, wind, hail exclusions. So it really has decreased by about 8% the number of projects that we are not able to lend in.
Nice. Well, there's definitely an opportunity there with maybe loans that people couldn't do previously under the guidelines. So just a nice win. Wanted to call that out. Thanks, Gretchen.
Thank you. Okay. Moving on, I'm trying to go fast because we have 10 minutes, 11 minutes left. Biggest obstacles of condo lending. Next slide, please. So we kind of talked about this a little bit, but it's really two things. The first one is the national insurance crisis. So, I mean, if you own a home, you own a car, you own anything that you pay insurance for, you know that those costs have gone up. So, insurance rates due to increased risk of major climate events and inflation have really greatly impacted HOAs. We're seeing as high as 50% increases since probably 2019 or 2020 in the HOA's expense lines for their insurance policies. Policies with per occurrence deductibles in excess of 5%. So we talked about, I mentioned named storms, hurricanes, named storms, wind and hail. Those are the most common ones we see. Sometimes that maximum 5% per occurrence deductible is not even available in the insurance market in certain areas. And so what happens is the HOA has to go and get that policy, and then maybe they have a 10% deductible, and then they have to go get an additional, what they call a deductible buyback policy of another 5% to get that down to warrantable guidelines. And those are acceptable, but it's an additional cost to the HOA. Sublimits is another challenge. We're seeing a lot of projects, especially in the like fire areas. The policy doesn't ensure 100% replacement costs. So maybe I've seen projects that were maybe insured in 2024 for $60 million. And then it's 2026 now, they come in and now they're insured for $5 million. And they say it's 100% replacement cost, but it's not. It's up to $5 million. So they are called sublimits, and we're seeing those in Hawaii also, where we see the hurricane sublimits, which I think that's kind of working its way out. One of our insurance experts in that area, she thinks maybe another 2 years and that'll work its way out. But these are still challenges in condo lending where the HOAs might not be able to get the required coverage for their projects that will meet Fannie and Freddie guidelines. Exclusions, I already talked about that. Wind, named storm, sinkholes. Sinkholes is a really common exclusion as well. And then pooled insurance policies. This is where HOAs, maybe usually most commonly through a property manager and sometimes by an insurer, that they put multiple projects that are completely unaffiliated. I mean, we saw one recently, it was like 1,600 projects nationwide on one policy with a limit of something like $12 billion when we looked at the replacement cost valuation for all of the projects was something like $70 billion. So the thought is that it shares the risk and you wouldn't have a loss in all of those projects at the same time. Kind of makes sense, but it's not eligible for Fannie Mae and Freddie Mac financing. They are not accepting pooled policies. There is a exception. Sometimes they have like a dedicated limit for each policy, and it really is the 100%. But those are rare, but we do see those. But in general, pooled insurance policies, which we're seeing them more often, if you haven't heard of that yet, if you haven't had us come back to you and say, I'm sorry, this project's not eligible because it has pooled insurance, you might hear of it in the future because it is one of the solutions that HOAs are coming up with. Building safety and critical repairs is the other reason that we're still seeing. So we don't have any lift in this area right now. So we're still, after the collapse of South Champlain Towers in Florida, where almost 100 people lost their lives in 2021, Fannie Mae and Freddie Mac responded with us looking at the safety of the buildings. We weren't looking at any of that prior to this time, special assessments. We were only looking, does the borrower need to qualify with the payment? So it really changed things. And it's a lot of states are also responding. Some of them were even responding earlier. And California adopted a law in 2019 that there had to be balcony inspections. That was prior to that. So we're seeing a lot of states respond to this with requirements for milestone inspections on certain types of buildings, usually high rises, but not always. Usually it's 3 stories or more, a lot of different things. So any project, we have to verify that if there's any structural defects, or deferred maintenance. So it could be, there's, 10 buildings in our 100-unit project, and there's constant leaks in the roof, and the roof is beyond its economic life, and the HOA doesn't have enough reserves to pay to replace that roof. We're probably not going to be able to lend in that project. So that's still a challenge. And then the other part of the challenge is the HOA is having to get these state mandated milestone inspections. It's creating a backlog. There's not enough inspectors, and there's not enough contractors to get bids on to do the work. And then the HOA has to adopt one of those contractors to do the work and get it approved by the board, and how they're going to pay for it. Are they going to pay for it from reserves or special assessments, or maybe a loan, or a combination of those things? So I would say the biggest challenge we have with this new guidelines is not just that so many of these projects were waiving reserves for many, many years, thinking that they'll just special assess for them when they needed to have them done, but it's the disclosure of this information, that the HOAs are not willing to disclose this information to us, especially from the third-party vendors like HomeWise, Condo. We are seeing movement, because if we don't have the information, it's not eligible. We can't approve it without having the information addressed. But this is really challenging in the condo space. So I would say these are the top two: insurance and building safety and critical repairs. Next slide, please. So Fannie and Freddie define critical repairs as seawalls. Like I hear people say, well, the seawall, my unit's not impacted. It's not even near the seawall. Well, we have to review the whole project. So if there is a seawall that needs to be repaired, that's been identified by an inspection, that project's not eligible till that work is completed. Elevators, including elevator modernization, waterproofing, any water intrusion anywhere. We're seeing it most commonly in the roofs, decks, bricks. I forget, there's an actual word for that. Spalling in the parking garages, pooling, puddling, concrete. They say, people again will say it doesn't impact our unit. It's not by our building. It's on the other side. It doesn't matter. We have to warrant to the whole project. Stairwells, balconies, foundation systems, electrical systems. That includes like fire safety systems, parking structures, and other load-bearing structures. So if you see the word spalling, the project's probably not eligible. Next slide, please. So building safety and critical repairs. The things that we need as a lender to evaluate the project is inspections. If there was an inspection completed in the past 3 years, we are required to have a copy of it. So if they say, yes, there was an inspection, there weren't any findings, we are not releasing a copy to you, the project's ineligible. We are required to have a copy of it and review that inspection. So we're still struggling with HOAs not being willing to provide that information. And as a lender, we're required to review that information. Special assessments. If the special assessment is associated with a critical repair. So again, in our examples, a special assessment is to replace all the roofs that had leaks and were over their economic life. They're over 20 years old in our example. Then if the roofs aren't completed, that project is not eligible. It doesn't matter if the building we're lending in, their roof's completed. We have to review the entire project and how they're paying for that too. So the last comment is all work must be completed. So we have to have evidence that the work's completed from a licensed contractor or structural engineer. Letters from the HOA or property manager are not acceptable evidence. So we end up getting these emails that say we had an inspection, they didn't find anything, or we were in the process of, we had a special assessment, it was to replace the roofs, it's all done, and you don't need anything from us. The project's ineligible if we cannot get that documentation, including that everything's been paid and how they are paying for it, if they're still paying for it. If they're still paying for it, there's a lot of things that we can do as long as that work's complete. There's a lot of things we could do if they're still paying for it. That's usually acceptable. If the HOA took out a loan to pay for it, that's actually really good. We like that when they take out a loan to pay for these things. So don't think that negatively impacts the project, but the work does need to be completed, and we need that information from the licensed contractor or structural engineer, including evidence that it was paid for. Next slide, please. So, what solutions are there when a project's ineligible? So, we talked about what we need to meet all the warrantable guidelines. What can we do when it doesn't meet those guidelines? So, the first thing is we have expanded eligibility at Newrez under our smart product, and it's pretty competitive. We do a lot of projects under these products, and it's a lot of fun because we're able to say yes to so many things that other lenders are not able to do. So it's really fun. My team loves reviewing these. Once we do a loan in a project, we can do up to 20% of the project under these products. 10% in Florida, and no more than one unit in projects consisting of 10 units or less. But most projects we're looking at 50 units or more that have these kinds of issues. So what are we able to do? Just because it's not eligible, like some of the examples we gave, hurricane sublimits are not eligible under this either. So just because it doesn't fit in Fannie and Freddie doesn't mean that it will fit under our Smart Series expanded eligibility. So what will fit? Condo tells. We're really approving about 80% of the condo tells that we review. The reasons we're not able to approve them is if there's frequently there's time sharing in the project. We won't lend in projects that allows any time sharing, even if nobody's time sharing. We weren't able to lend in projects where there's any restrictions on occupancy by the borrower. The borrower has to be able to occupy that unit as a primary residence, even if nobody in the project does and our borrower is an investor. We still have to verify for that. And then the last reason we're not generally able to approve a condotel is when the condotel operates the rental of the units in the project. And they operate it like a business where all the units that are in the rental program run like a business and they contribute to the HOA's income to pay their bills. That doesn't work either. Rental pooling. Commercial space, we go up to 50%. So I gave you the examples. Think high rise with commercial space. It can even be a hotel down below it, and then the condo sits on top of it. We go up to 50%. Single entity in our 100 unit project, now we can allow up to 49 of those units to be owned by one entity. A lot of times when it's that high, we have that single entity selling units. We might be able to go a little higher on those. Delinquent HOA dues, delinquencies are becoming a really big issue because on those full reviews with the retirement and limited and streamlined reviews, we were restructuring to limited streamline review where we didn't have to warrant to the HOA dues. Now with that requirement changing on August 3rd, we will go up to 25% where Fannie and Freddie go up to only 15%. Rec leases and mandatory memberships, think like ski clubs, golf clubs, beach clubs. Those are generally eligible under the SMART products. There are some restrictions on those about what percentage the cost is to the HOA dues and if there's any joining or annual fees. We do have expanded litigation considered. We still won't do structural defect litigation. So it's just a little bit of, it makes sense, but it doesn't quite fit under Fannie and Freddie. And then expanded insurance deductibles. When you have those per occurrence insurance deductibles that are over that 5%, that example I gave you for Fannie and Freddie, like maybe we have a 10% hurricane deductible, we are allowing those under the SMART products. I think that's it. Is there another slide?
No, I think that's there's a wealth of information there, Gretchen. Again, we always love to tap into your knowledge. Saw a lot of great things in the Q&A. I do want to kind of give a shout out, like follow myself, follow Claire, follow any of your AEs, because we will take a lot of the questions that you jumped into the Q&A and come up with an FAQ. I know Gretchen and her team offer at Newrez our ability to review a lot of the condos up front and give you some pre-approval on the condos before you go too deep. So again, follow your AE, ask your AE questions. We'll be getting out a copy of the deck as well. I saw that as a lot of a question. So again, thank you for your time, Gretchen, and hopefully everybody found it of great value. So appreciate your time.
Thanks.
Thanks, everyone.
Thanks,
Thank you.
everyone.